In this video, we're going to start introducing derivatives. So the first video on the derivatives playlist, and it's going to be a very gentle introduction because the current version of the curriculum does indeed follow what is a very indeed gentle introduction into the topic. So you'll see that if you've got some exposure to derivatives already, you'll probably know most of these things, if not all of them. But there are obviously heavier topics coming in subsequent or later videos. So let's begin with a definition of what a derivative actually is. A derivative, as your curriculum defines it, is a financial instrument that derives, hence the name derivative, that derives its value from the performance of something else. From the performance of, and here a very special word, which I'm going to use a different color for, of what's known as the underlying or the underlying asset. Something else, which a derivative is function, that something else is known as the underlying. Now, this could be a single asset, for example, crude oil, natural gas, thinking about commodities, or maybe shares of a company and their price fluctuations. This could be a some kind of group of assets which are grouped into an index like the S&P 500. So single asset, a single share, but many shares are grouped into indices, or perhaps some market variable which is not really linked to the price of an asset, e.g. the interest rate, for example, could be such a market variable. Now, what derivatives allow for is the following. Derivatives allow participants in the financial markets, so market participants, to exchange cash flows in the future. Typically, one side pays money to another side, or the other way around. So exchange cash flows, which are going to be based. So let me add in the future. Everything here is going to happen in the future, based on how that underlying behaves. So based on the value of the underlying, whether it goes up or down, or is above or below a certain predetermined level, pre-specified level. Right, so what I'm going to do is actually, without going into too much detail, I'm going to show you an example. This example is going to show or illustrate certain concepts, and I'm going to base them around what's known as a forward contract, which is one of the most basic types of derivatives you may find. And later on, you'll be learning about forward contracts as well as other derivative types. So I think it's best to draw a little timeline over here. And on that timeline, so this is a time axis. And over here, I'm going to say that this is today. And I'm also going to label another point, imagining that this is a point that is 60 days later. Now, I'll come to the significance of that moment on the timeline in just a moment's time. Imagine we've got two participants in the market. we call them participants here, but now I'm going to use a more sort of specific and more professional word. I'm going to call these participants counterparties, because very often those participants who engage in derivatives are known as counterparties. So I'm going to have counterparty A, and I'm going to have, you guessed it, counterparty B, being the two sides of a transaction or a trade that is actually entered into today. So what they're going to do is they're going to enter into a derivative contract that's going to, bind them. And under the terms of the contract, let's imagine that A, the top one, agrees to deliver 100 ordinary shares of some company, and B agrees to make a payment, and that payment is going to be, let's say $50 per share. But the thing about it is, nothing's going to happen today. This transaction calls for the delivery of shares and the payment of a pre-agreed amount of money, but it will not happen today. So we kind of break this and say, well, not yet, not today. We're going to have to wait for that to happen. And this will happen actually 60 days later on a date that I'm going to label as the settlement date, right, for the contract. So the only thing that we do today, or these counterparties do today, is they agree the terms of a transaction which will actually take place at a later point in time. And in my example, it's 60 days later. However, obviously in reality, it can be any future date. So counterparty A and counterparty B shall meet again at some kind of forward date, hence this is known as a forward contract, and they will in fact exchange those 100 pre-agreed shares in return for a pre-agreed amount of money, which is $50 on a per share basis times 100, giving a nice 5,000 over here. Right, so we've already said that these are counterparties. I'm going to write that term down in just a moment again. However, let me label some other important features of this transaction. Well, let's start with this. This is a pre-agreed amount, which we already kind of enter into the contract today, based upon which we will make payment, or one side will make payment to the other. This is in the future. This is known as the forward price. Okay, a very important feature of forward contracts is the pre-agreed forward price. What else? The shares will be referred to as the underlying, because the contract is all about the delivery, the buying and selling in the future of shares. However, this total amount or total number of 100 shares will be referred to as the contract size. So contracts have an underlying, what they pertain to, what they relate to. In this case, it's all about shares of a specific company, I guess, but also a certain size. That's the contract size, and we've already labeled the forward date over here. So what's important is that the actual exchange of underlying for the forward price already pre-agreed, obviously multiplied by the contract size, takes place on the settlement date. Now let me also label over here the sides of the transaction. Again, well, not label necessarily, but write them out. We've got counterparty A, who is the future seller, at that, at that settlement date. So A is going to be described as the forward seller because they'll be making the delivery and receiving payment. And I'm actually going to say something that you'll find we often use in other places in the curriculum when discussing positions that one takes in the markets. I'm going to say that they assume or take on what's known as a short exposure. This idea of short has nothing to do with the notion of time, this being 60 days or some other period of time. It's not about the length of time here. Having a short exposure means you benefit. So this counterparty A will benefit if, the price of the underlying, in this case, the share price, falls during this period of time. Why? Because they've agreed to receive $50 on a per share basis, and they will indeed be quite a happy counterparty if it turns out at that date, 60 days later, that the shares are actually in the market selling for less than 50, but they've got a counterparty who's committed, obligated to pay them more than the market value. At the same time, counterparty B who would be described or may be described as the forward buyer in this transaction, well, we would say that they have what's known as a long exposure. And once again, nothing to do with the notion of time. The long exposure means that B is somebody who would definitely benefit, so benefits if the price of the underlying, the price of the shares being delivered and received here, the underlying price actually goes up. Because B has committed to receive shares and pay a pre-agreed price, forward price of 50, and if it turns out that on the settlement day, those shares are worth much more in the market, they've got a higher market value, well, they can still get them for 50. A is obliged to sell those shares to B for a pre-agreed 50, and B can go on and sell those shares for a higher price in the market. Once again, making them a happy counterparty. So I've left the example with the terms of the example transaction because I still want to draw on it when discussing different ways in which derivatives may actually be settled, i.e. what happens on the settlement date. Because what we saw over here was, what I kind of assumed over here quite naturally, was that this derivative would settle via something called, or by means of something called, physical delivery. But there is another way to settle derivatives. It's called cash settlement, and I want to show you both ways and actually explain why, from an economic perspective, the outcomes are the same, irrespective of how we settle. So, two ways to settle a derivative contract. One would be physical delivery, which is pretty much what I assume happens over here. And the other way is called cash settlement. Now, so I want you to imagine that this, settlement date has come. So we're already 60 days into the future. And at the settlement date, we need to assume some level for the true market value of the shares. We would call that the spot price typically. So at the settlement date, the market price of the shares in question, which obviously are the underlying in this transaction, let's say it equals 40. And 40 is obviously less. $40 per share is less than the forward price, which was agreed at 50. Irrespective of what is the market price, this is a binding commitment, so you can't back out of it. You can't just back out of a forward contract and say it doesn't really suit me. So if we're doing physical delivery or settlement via physical delivery, what will happen is that, like before, pretty much A and B will get together, and in the pre-agreed fashion, A, who's the forward seller, will deliver 100 shares, and B will pay an amount equal to 50 per share, the pre-agreed forward price, times 100 shares, so 5,000. Right. Now, what I want you to think about is the feelings that both sides have. A, who's the seller, at a time when the market price is just 40 per share, I'm sure feels a pretty high level of satisfaction with what they've done. They feel that they are gaining, right? Because they're receiving a pre-agreed 50 for something that in the market right now is only trading at 40. In fact, if they didn't have those shares before in their portfolio, they could now buy them at 40 and sell them to B at a pre-agreed 50, which B cannot back out of. So, this creates a gain, which is either a paper gain on a sort of as compared to the market value of the instruments being sold, or a real gain, a realized gain, if they indeed have to buy these shares in the market now for the lower price and deliver for a higher price. But the gain is one of 50 minus 40, obviously times 100 shares, and that's a $1,000 positive gain, which puts a smile on A's face. On the other hand, B will be less than happy, because for them, this transaction generates a loss as compared to market conditions. They are forced to pay $50 per share for something and receive something that in the market is only worth 40 per share. So for them, that creates a feeling of loss. And obviously, it's the same as over here. So it's 50 minus 40, or you could swap these numbers and say 40 minus 50 times 100. If I did that, the number would come in negative. I'm going to make sure it's a loss of $1,000, even though mathematically this suggests a positive number, but I just wanted to draw the analogy to what we had before. So please appreciate that these gains or losses, which both sides respectively feel, are absolutely commensurate. They're absolutely in line with what we said before about the counterparty B having a long exposure. And if you are long in a contract or in financial markets as such, it doesn't have to be with regard to derivatives. If you are long, you will unfortunately generate a loss if the underlying price goes down, but you do benefit if the price of the underlying goes up, or any sort of financial market variable that you have a long exposure to. On the other hand, A, who was described as the short, lives up to the definition of having a short exposure, because they benefit, so they make a gain from the underlying price going down. Underlying price going down, and that's absolutely what happened over here. However, the point is, derivative contracts like forwards don't always have to end in this kind of physical settlement, which involves the delivery of the underlying for a pre-agreed price, creating this exchange over here. They may also be cash settled. So knowing that one side loses and the other gains, obviously, as a result of the actual market value of shares being at a specific level, 40 per share, why not just simply say that instead of doing this, I'll sell you shares, you'll pay me a pre-agreed price, why don't we just turn this into a transaction that settles by a net payment equal to the difference in prices, the forward price minus the actual market price over here. So 50 minus 40 times 100 shares. And it was obviously B who we said take the hit. The long loses if the price of something drops, and the short benefits. And to keep that absolutely the same as before, why don't we just organize an exchange of money for the net amount, a cash payment from one side to the other? And if, the long does indeed want to get their hands on the shares, they can still do so. They'll pay whatever is the current market price. That's 40 per share. So if they want to buy in the market 100 shares, they'll pay 4,000 for them, but they also transfer 1,000 to A, making the purchase effectively for B worth 5,000. At the same time, if A is indeed interested in selling their shares, maybe they are, well, they can sell their 100 shares in the market for the prevailing price of 50, generating proceeds of 4,000, but they get an extra payment, cash payment from B equal to 1,000. So in the end, the total amount, when you consider the price for which the shares are sold plus the net payment from B, amounts to 5,000 or 50 per share. You see, this is what we mean by saying that the two ways of settling, from an economic perspective, create very indeed equivalent outcomes. In this introductory learning model on derivatives, in fact, the first one in the curriculum, the authors also go on to state that derivatives may come either in standalone form. So what we have are standalone derivative contracts or derivatives, and an example of such a standalone derivative is something that I showed you before, that forward contract to buy shares in the future. However, they also sometimes come in the form of derivatives that are embedded or built into some other instruments. So embedded derivatives. And that, as I said, means the derivative is built in, or built in sort of into another financial instrument, into another financial instrument. It would be typically shares or bonds. Examples of such instruments would be put options, call options that you'll find built into bonds, but also conversion options that may be built into preferred shares or perhaps into bonds. So let me write down, e.g., put, call, or conversion options. And in fact, we discuss put calls and conversion options also that are built into bonds in the section on fixed income. That's a relatively big component of your learning on fixed income, on debt instruments. But for now, in this topic area, I want to give you a little bit of an example of the conversion option, as built into a bond. So the example is as follows, right? This has nothing to do with standalone derivatives. We put them to the side here, and the example is as follows. Let's say you've got a 5-year convertible bond, and it pays a 4% coupon, and also comes with $1,000 of so-called face value. And what that means, what these parameters mean, will become very apparent, very clear when we lay this out once again on a timeline. So this is a timeline. Over here we've got time 0. That's right now the point at which the bond is, I guess, issued. End of year 1, end of year 2, end of year 3, 4, and 5. And 5 is the maturity date for the bond. So this is a 5-year bond, but it's going to be actually a convertible bond. Until the maturity date, it behaves in a very standard way. So it pays a 4% coupon. In order to calculate the amount of money, the dollar amount of the coupon, you just take this coupon rate and multiply by the bond's so-called face value. So $40, $40, $40, another 40, and a final 40 on the maturity date. Now, on the maturity date, assuming this is a classic sort of straight bullet style, so-called bullet style bond, more on different cash flow structures in the playlist on fixed income instruments, you should receive as an investor this nice round $1,000. But if it's a convertible instrument, you may go, instead of receiving 1,000, you may choose to receive a pre-specified number of shares from coming from the issuing company. So let's say 1,000 or 100 shares, obviously of the same company that has also issued the bond. So over here, 1,000 or 100 shares, and it's up to the investor to actually decide what they want. So there is no commitment here in the sense of an obligation to go for the shares. There is the choice to maybe decide to take the shares if the investor decides that is the more favorable decision from their point of view. And if you think about it, you know, the choice, whether we go for one thing or the other, the choice will depend, on the price of the underlying. And the underlying here are the shares of the company. Everything hinges on the share price on the maturity date. And whether it is above or below $10 per share. Because if the share price is below this level over here, below 10, it would be wise for the investor not to take the shares, just take the nice flat 1,000, which is a guaranteed amount. However, if the share price is above $10 per share, the investor should go for the shares, choose the 100 shares. Because their value, obviously the value of 100 shares times an amount of more than 10 will give them an outcome, a result which is more than the guaranteed 1,000. And obviously, the higher the share price is, the more you can gain from this. Now, this is yet another type of derivative which has as its underlying the shares of the issuing company. So what happens, and you know, whether the investor gains or doesn't gain depends on the future level of the share price, the value of a single asset. And it's a derivative that doesn't function on a standalone basis. It's a conversion option which is just like put or call options, which may be built into typically bonds. They may also be built into specific types of shares. Now, and it's up to the investor to decide what they want to go for. So a classic, a classic derivative, although a slightly more complicated one, I admit. Now, you've seen two types of derivatives now, forward contracts and now these options, although options built into something else, so embedded instruments, but options also do function on a standalone basis as instruments in their own right as well. So let me just say that we identify, on the one hand, instruments that create firm commitments. So firm commitment, or alternatively, what's known as a contingent claim, where how things play out depends on the level, for example, here of the share price. So in the case of contingent claims, I think this is easier to start with because we've just done an example of one, an option. One of the counterparties decides or chooses, how should I put this? Chooses whether to actually settle on pre-agreed terms. And a prime example of this is an option, because in an option, you may settle, and the settlement here is a little bit abstract. With this conversion option, you give up the right to receive 1,000 in favor of getting 100 shares. So there is some kind of exchange here, some kind of settlement between the investor and the issuer of the convertible bond, and you give up something in exchange for something else indeed. And in this case, the counterparty who has the choice is the holder of the bonds, the investor. Whereas in a firm commitment, well, this type of contract creates a kind of a binding obligation. It creates an obligation to settle. It could be settlement via physical delivery, or it could be cash settlement to settle for both sides of the transaction, so for both counterparties, and they can't just walk away and decide not to do it. Like here, with the option, the investor may decide not to kind of exercise or use their option to receive 100 shares by giving up the 1,000. They may still choose to go for the 1,000 if that's more favorable for them. So that's a typical feature of a contingent claim. However, forward contracts, as well as stuff that you'll learn about later on, futures contracts which trade on exchanges, but also swap contracts. These are examples of firm commitments that you can't just walk away from. You can close your position or your exposure by entering offsetting positions, but that's not the same way as the choice that you have with options. So I want to wrap this introductory derivatives video with a short, brief discussion of derivatives uses as sort of supplied by the first learning module in your curriculum on this topic. Well, one important use of derivatives is to increase or indeed decrease one's market exposure to whatever is the underlying asset, or to the underlying, just simply because we typically use this as a verb, the underlying. So if you didn't have an exposure to a company's share price, by having a convertible bond which has an inbuilt conversion option, you all of a sudden have an exposure to that share price. And in fact, it's a long exposure because you will benefit if the share price goes up, the share price of the company, which will allow you to get something better than the promised $1,000 from the previous example. Or maybe you already have an exposure and you want to limit it. Well, you can typically do that by creating some kind of opposite position in derivatives. And actually, over here, if you want to reduce your exposure and you are offsetting or let's say neutralizing an existing exposure that you already have, perhaps as a result of your normal business operations or some investment holdings, we call that hedging. And later on in our discussions, we'll be often mentioning that many people use derivatives as hedging instruments. So this is, okay, the hedge is the derivative itself is a hedge derivative, but the action is called hedging. I said hedging, but I wrote hedge. Hedge is the name that we give to the derivative, which is a hedging instrument. Okay, what else? Well, you may use derivatives for shorting. So to establish a short exposure, shorting, because you want to profit from a price drop. Well, derivatives allow you to do so synthetically, obviously price drop in the underlying. Somebody who has a short exposure. So, for example, in forward contracts, is the seller, the forward seller, has a short exposure, and they will benefit if the price drops. And if you are settling in cash, it doesn't mean you have to really deliver something to somebody else. You receive a net payment, which, if the price drops, will be a positive payment for you. The more the price drops below the forward price, the more you gain from the contract. So this is, to establish a synthetic sort of position. You may also use derivatives for diversification purposes, so portfolio diversification. And there are plenty of strategies that we will also be discussing in this section of the curriculum, so the derivatives section of the curriculum, as well as possibly in others, especially at high levels of the CFA Level 1 curriculum, where you may use derivative contracts for sort of synthetic diversification, especially by taking positions in index derivatives, index-based derivatives, etc. What else? Something that I've sort of mentioned here as under offsetting. You may use them for offsetting. I think offsetting is actually spelled with one T. So offsetting some kind of financial exposure that you may have already existing from some commercial transaction, right? From a commercial transaction. This is especially true if you are conducting business across borders and you may be dealing in different currencies, and you can use derivatives to offset the risk that the currency in which you need to settle a transaction moves unfavorably for you. What else? Now, a point your book makes, I'm going to write it down, although it does require a bit of explanation, and things will become much more clear as we do more on this topic. Derivatives allow us to creating a large exposure. When I say exposure, and I say this a lot of the time, exposure means you all of a sudden start feeling like you care about whether something will go up or down, because you may benefit from it or lose on it, depending on how the underlying behaves. You actually are in some way, invested in it, although previously you weren't. And if you do this via derivatives, that's a synthetic exposure. Creating a large, obviously, exposure, but synthetic via derivatives to an underlying. This could be the price of shares of a company, or it could be, the price of a commodity like oil, gas, something like that, to an underlying, but with a relatively small, at least small compared to the size of the exposure, cash outlay. Typically, derivatives these days force counterparties in derivatives are forced to put in a certain amount of money, known as margin, as a sort of safety deposit to cover their potential losses, especially in the case of things like forwards, futures, or swaps, where you can you can rack up losses, and the other side may rack up big gains. Now, the size of the margin or the cash outlay at the beginning is relatively small compared to the size of the volume of the transaction, the contract size, and that gives rise to a very important concept called leverage. Leverage is typically used to describe a situation where you're making an investment that is at least partially financed by debt. Well, in derivatives, there is no debt as such. It's just that the scale of the transaction is augmented. The contract size is quite large relative to the amount you put in, and that's also described as leverage. And just one more remark, which is not about uses. It's more about, generally certain benefits of using derivatives. Later on, you'll also see plenty of potential risks of using derivatives, but derivatives typically have lower transaction costs. So taking a position in a derivative, especially if it's exchange traded, will often involve lower transaction costs than if you were to take a position in the underlying asset. So think about the underlying asset being, for example, shares. And in order to get a long or short exposure to shares, you need to go and physically buy the shares. Or if you want to do a short exposure to shares in the actual stock market, you would have to do what's known as a short sale. So arrange a borrowing of shares, sell them with a commitment to purchase them back in the future. With derivatives, you can do that much more easily, or get a synthetic short position, for example, or long position indeed as well. And it's less costly. Plus, the derivatives market is often, or derivatives trading is often more liquid, once again, than trading in the underlying asset. So both these remarks, we will be expanding on them in subsequent sections of this topic area, but this is, this lower or more, this is all in relation to the market for the underlying asset. So it makes sense to take synthetic positions rather than trade the actual thing that the derivative pertains to.